Hey everybody, RC Peck here. So good to have you here. I've got 3 price charts that I want to show you, and I want to keep it powerfully simple. And I'm going to do things a little different today. So I want to go over 3 price charts, but then I'm going to hit the pause, and then I'm going to continue talking to my subscribers because there's a couple other things that are going on that I want them to make sure you get. And so if you're a subscriber, just go ahead and log into the research department and you'll get the other half of this video. Okay, so let's start. On the screen here, I have SPY, which is the Spiders S&P 500 ETF. This includes dividends. And look, it's a 3.5-year price chart. The black line is the close of the day for SPY. And look, I just put on a simple... I actually put on an exponential 50-day moving average. I don't use the 50-day because there are much more accurate ones to use, but I'm using a 50 because it's simple and a lot of people know about it, even though it's not the best one. It's kind of like if you learned to bake something from your grandma and you always baked it in a certain Pyrex bowl, and you just thought that's how it was always supposed to do. And then one day you asked your mom about why your grandma always had it in that size bowl, and she goes, well, that's all they had the money for. And I think of the 50-day very similar, like, well, that's just what came as a default on my charting software. That's just what I see as a default on any stock charts. But in fact, it's not the best one, but I'm putting it on here for a point. So if you look at the screen, especially up here, you can see that the price is above the blue line, but it's not as high as it's been before, right? So at the beginning of 2018, it was much higher against that 50-day moving average. Not that the price can't correct. But the one thing I just want to point out is if the price of the stock market, I'm going to say the stock market, even though I'm talking about the S&P 500 and the U.S. stock market, but if the corrections happen above, say, this 50-day moving average, then it's hard to get worried. It's hard to get scared about what is happening. I would not be surprised to see a 5% correction in the stock market. It also wouldn't surprise me. I'm just going to see what the number would be. 5% gets us to, say, the November peak there. And then a 10% correction gets us to the July high and the September high of last year, which to a lot of people wanting to scare themselves and others was the it's all gonna come apart now. So I would not be surprised to see a 5 to 10% correction. Now, what's interesting about that is I'm going to move over to bonds now. This is BND, the Vanguard Total Bond Market ETF. What's interesting about bonds from just an absolute price point of view is bonds from a BND point of view have broken up and out. So they're at new lifetime highs. And what is interesting to me is the bond market is now saying things are getting more dangerous out there, right? Because BND had this consolidation, or the U.S. bond market had this consolidation, and now, at least from the measurement of BND, it's breaking out. And yet, the stock market is having a very different experience right now. And I've talked about this in the past where it used to be the bond market was the smartest person in the room, but I believe that's changing. And I believe it's changing for 2 main reasons, if not more. But one of the main reasons is as U.S. population ages and more people get over the age of 50, they are moving more of their money into bonds, not because of necessarily, I'm just going to say, market worry, but more because the income growth and stability that has come from their career, no one's ever trained them how to have it come from their saved money. And so they've been taught that you just put some away in bonds regardless. So what's happening is the aging of America, you're seeing more people go into bonds simply because of their circumstance and not because the stock market is warning. And that's a big distinction. And the other one would be simply because of what's going on with the Fed and interest rates and them expanding their balance sheet. But nonetheless, it doesn't actually in many ways matter why. It just is, look, bonds have broken up and out. And as I said before, stocks really haven't done anything. I mean, they're down maybe a percent. I just want to see how far down they are. They're down from lifetime highs less than 1%. And the bond market is breaking up. So there's a bit of stocks and bonds not agreeing. And the last thing I want to show you is a price chart of gold. And this is, let me just see how many years of gold this is. This is just 3.5 years price chart of gold. It's actual gold price chart. And gold had a correction and then has broken up and out of that correction, or it's in the process of breaking up and out of that correction. And this is important from a couple reasons. One is the Fed started expanding their balance sheet in September of last year. I actually believe the first expansion was on September 11th of 2019. And they've expanded their balance sheet, I'm rounding here, about $400 billion. And gold fell all the way into, call it November 1st, but it didn't really break out. I mean, you could call this all falling, and then it didn't really break out until near the end of December, and then gold is breaking up. So it's interesting because this is in face of money printing. So one of the questions I put out there to the market is, does gold not care about money printing anymore? Or is gold finally caring about money printing, where in the past when Bernanke and Yellen did it, gold fell, but now gold is not falling. So something different may be going on. But the point is to look at all of these. And I've got some big stuff, big shifts coming up that I'll be releasing with you guys in the next few weeks. And one of them I used for an ad on Facebook, the Rosetta Stone. And I've had this idea of there's got to be a filter. And I mean, there is a filter, but there's got to be a way to describe a filter so people can always know what to do. Because one of the biggest problems I see is when someone hits the age of 50, what they notice, whether they use these conscious words or not, is they start noticing, look, the success I've had in my career, that's brought me income, that's brought me growth, and that's brought me stability. But once someone hits 50, they start noticing there's a point in time I don't want to work this hard. There's a point in time I don't want to maybe work at all. I want to have the choice to not have to work. And so what they're saying is, how do I get that same success that I got from my career that produced that income, growth, and stability? How do I get that with my saved money, with my accumulated money, right? How do I bridge that gap, right? How do I get that same success that I got from my career to get that with my investment money? And it's interesting because people often believe it's the same skills, and it's not, right? People often believe that if you just go hire a big box advisor, they'll get you that income, growth, and stability from your money. But anyone who's done that, they know that's not true. And so the idea behind the Rosetta Stone that I used on the front end of my marketing on Facebook was there's a way to always know. And I'm just going to hint a little bit of what it is. It's 3 letters. This Rosetta Stone is 3 letters, meaning the filter, this process is 3 letters. And the 3 letters are IEA. I stands for information, E stands for emotion, and A stands for action. And the reason I'm so excited about framing it this way is because it's very easy to understand. One of the issues across the board I've heard for over 2 decades in varying uses of words and languages, I don't know when information is right. I don't know which information to follow. I don't know which pieces of information is significant and which is not, right? And so since people don't know how to sort and filter for what is significant and where the signal is, what they do is they use something called heuristics. Heuristics is an economics term. I believe it's an economics term. It means a rule of thumb. Right? So if you don't know how to figure out what is significant and what is not, what the human brain will do is go, well, I like that guy over there. Well, I like that gal over there. So I guess I'm going to follow their information. But the problem is those rule of thumbs don't work anymore. Maybe they worked in the 70s, right? That's not a good heuristic anymore, especially with thousands of pieces of information, data hitting your brain every day. if not, or every week, if not every day. So people have never been trained how to say in a very quickly, very verifiable way, does this matter, right? Or is this significant? And once people have that step of getting that answer, their fear and anxiety and stress and angst and worry and overwhelm disappears. But it's not enough just to know the I. The next step is the E, which is emotion. Okay, now that I have that piece of information and I've filtered it properly, what's the emotion that goes with that? And is that the same emotion my money is having, right? Because you have the human emotion and then you have the emotion of your money. And so this second step, which is the E, is, okay, now you've learned this piece of information. Now, from an emotional point of view, from a behavioral point of view, from a psychological point of view, from a feeling point of view, really from a human point of view, now what is going on? And then the third step is the action. It's A, which is, okay, I now have the information. I've sorted it properly. I know whether it's significant or not. Okay, second step is understanding, identifying, managing that emotion and knowing what to do and knowing what questions to ask it. And the third is I now have to take action, whether doing nothing is the action or actually taking action. And the best part about how I train people to take this action is you can take action, and even if you're wrong, you won't get hurt. And I believe this is one of the things that stifles people and freezes people and hurts people, because they've never been trained how to actually take a step, take an action in a way where even if they're wrong, they won't be hurt. They will still retire. They will still be able to give back to their cause, their community, their loved ones. And it's this process, this IEA process, that is actually the Rosetta Stone of investing. So you're going to hear more about that. And I'm putting a TED Talk-like just presentation together so you can really understand how it works. And I'm going to give real world examples so your brain can be like, oh my gosh, that's right. That's what it is. So thanks, guys. This is RC Peck with Fearless Wealth. I appreciate you being here, looking at SPY and what's going on with it, looking at BND and how it broke up and out, and looking at gold, really just wanting to figure out, does it move higher? Does it not move higher? Gold's up against some gigantic resistance right now. Bonds are not. So it'll be very interesting what is going to happen. And this will happen sooner than later. This will not happen in years from now. But I think over the next couple weeks, maybe even over the next days to weeks, we're going to see something, a potential kind of big move. So I will let my subscribers know the rest of it. I'm going to hit the pause button here, and then you can take it up. If you're subscribed, just log into the research site. All right, guys, thanks so much.